Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Vizio stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Vizio designs and sells television, soundbars, viewer data, and advertising space on its platform. Its advertising revenue is the smallest, but growing rapidly. The company is headquartered in Irvine, California, and was founded in 2002. It went public in 2021 and trades on the New York Stock Exchange. It is known for selling its HD TVs at lower prices than its competitors. In 2014, Vizio acquired Advanced Media Research Group. That's the parent of entertainment website Buddy TV, which was subsequently shut down in 2018. In 2015, it acquired Cognitive Media Networks, a provider of automatic content recognition. In 2016, Chinese electronics company Lieco announced that it would acquire Vizio for $2 billion, but the acquisition never went through. In 2016, it launched its SmartCast streaming service across all television sets, including apps such as Netflix, YouTube, and Disney+. In 2018, it launched a free streaming service called WatchFree, powered by Pluto TV, on its SmartCast platform. It currently has 13 million active users. It is the second largest seller of flat screen TVs in the US. To date, it has sold over 11 million soundbars and 80 million TVs. In March of this year, it IPO'd selling 12.25 million shares at $21 each. After fees, the company received $145 million. Let's get started with the model. This is a mid-cap company, 4.2 billion market cap. They're trading at $23 a share, and they have 184 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see they have positive free cash flow each year, peaking in a trailing 12 months at 139 million. Net income is the profit or loss on the income statement. It's revenue minus expenses. They had a small negative in 2018, but nearly 100 million in the trailing 12 months. Revenue is the sales for the company, and that grows nicely each year from 1.8 billion up to 2.2 billion. This is their income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that more than tripled from 2018 to the trailing 12 months. Below that is operating expenses. Gross profit minus operating expenses gives you your operating income, and that's been growing a lot, up to 135 million in the trailing 12 months. And the bottom line of the income statement is their net income, and that's nearly 100 million in the trailing 12 months. So their income statement looks really good. Their revenue is a bit concentrated. One customer makes up 41% of their revenue, another customer is 15%, and another is 12%. They don't say who these customers are, but I'm pretty sure A and B are Costco and Walmart, just not sure what order. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit and loss. It's not actual cash. So they generated over 142 million of operational cash flow in the trailing 12 months. That's really impressive how much they're growing their business. And they don't have much in CapEx, only 3.8 million. Operating cash flow minus CapEx gives you your free cash flow. And they do have positive free cash flow every year. They did IPO this year, so they received 148 million from that IPO. And it looks like back in 2018, they issued 70 million of capital stock, and they issued 107 million of debt, but they paid down more debt than they issued that year. Let's look at their capital structure. They have 313 million of equity and no debt, so they're 100% equity. And their WACC, their weighted average cost of capital, is 7.6%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 5.8 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $5 billion. We divide that by 184 million shares. And we get a calculated stock price of $27. They're trading at $23, so they're trading at a 16% discount. It's a buy according to the model. So the way I valued this company, I looked at analyst estimates, and I also looked at the company's projections. Based on how well the company's doing, I grew their free cash flows 20% each year, which I think is a pretty conservative estimate. I think they'll do better than that. And I still calculate a stock price higher than they're trading at. Simply Wall Street values them at $6, so they're saying the stock is really overvalued. 6 analysts priced this stock and the average price target was $30, so that's pretty close to where I am. So the stock IPO'd at $21, and you can see it's been up and down. It looks like it peaked at around $28, and then it looks like at some points it fell below $20. But if you're bullish on this stock, I think you should just hold it and ride the ups and downs, because you can't really time these things. And if you're bearish, just don't buy it. In the first quarter of this year, the company sold 1.5 million TVs, up from 1.2 million the same time period last year. They had 8.5 million streaming accounts in the first quarter of last year. That went up 50% to 13.4 million. The more users, obviously the more eyes that watch your platform, but you can charge your advertisers a lot more money to advertise on your service. So focus on users. The sites with the most users are the most valuable. The total hours of TV watched went from 4.9 billion to almost 7 billion. And the streaming hours went from 2.1 billion to 3.6 billion. All their numbers are improving dramatically. The average revenue per user went from $8.23 to $14.52. That is really impressive. The company IPO'd 3 months ago and the stock went up over 11%. The S&P 500 went up 38%, but that's in the past 52 weeks. The stock's 52-week low was 19, the high was 29. The stock is trading above its 50-day, but below its 200-day moving average. 1 to 2 million shares are traded each day on this stock. They have a really low float. Only 15 million shares are on float out of 184 million shares outstanding. That's because the founder and CEO of the company owns more than half the stock. And 2.5% of the shares on float are shorted. Analysts are bullish on their earnings, expecting them to grow 51%, while they expect their industry to grow only 11% and the market 16%. But analysts are forecasting their revenue to grow only 7%, and for its industry and the market, a little over 9%. In the past year, their earnings grew a lot, up 127%, its industry 65%, and the market 22%. If you invested $10,000 when this company IPO'd, you'd be at $11,100 today. That's 11% return in only 3 months. The founder and CEO of the company owns more than half the stock. He's worth $2.3 billion. He owns nearly 100 million shares. The next biggest shareholder owns 8%, then another 8%, then Theodore Wade at 7%, then Innolux Corporation at 4.5%. Let's look at their financial ratios. The average PE in the market's 33, the median is 22. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. Their PE is 44, so investors are paying $44 for $1 of earnings. That's worse than the market median and average. Their price to sales is really good at 1.9, better than the market median and average. Their price to book isn't so great at 14. That's surprising because they have no debt. I would expect a company with no debt to have a good price to book since they're all equity. Also, they have a really good ROE at 31%. That's also really surprising because when you take on a lot of debt, you can inflate your ROE. And they have no debt with a great ROE, so that's really impressive. Their current ratio is 1.4. They have a lot of cash on their balance sheet, over $400 million of cash. That's from their recent IPO, and $249 million of receivables. So the company is really well capitalized. They have a lot of cash on their balance sheet. They had $139 million of free cash flow in the trailing 12 months, over $200 million of working capital on their balance sheet, so they have $366 million of funding. The best way to look at ratios to compare them to companies in the same industry. I've done videos of 4 other companies in the same industry as Vizio. And if Vizio has a number in red, they're worse than the average in the industry. If they have a number in blue, they're better than the average. They have the worst PE on this list, although cost is probably worse because it has negative earnings, so we can't look at their PE. They do have a really good price to sales ratio, much better than average. They're at average in price to book. Their current ratio is below average because cost has such a high current ratio. And they're doing well in ROE at 31%. They have no debt, which of course is better than the average. And they're not a small company at 4.2 billion market cap. But in this industry, they look like an ant. Because when you have Apple, the biggest company in the world in your industry, it makes you look really small relative to the average. And Vizio does not pay a dividend, but I'm pretty sure they're going to pay a dividend this year or next, because they have a lot of free cash flow to pay that dividend. So to summarize, I have them trading at a 16% discount, but this company is doing a really good job at growing its business. Plus, most people these days do not watch regular TV. They use streaming apps and streaming services on their computer or on their TV to watch TV, movies, and shows. Almost all their business is in the United States. So they have a huge market, and even though there's other services like Hulu, Netflix, Disney+, there's a lot of people out there, so there's not a shortage of customers. Plus, they do have a slight benefit that they sell TVs to people, so already they have that relationship to leverage off of. So I'm really bullish on this stock, and I think they have a great future. I rank their free cash flow 6 out of 10, their revenue 7 out of 10, and their ratio 6 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.